For most of the last decade, Rajesh Exports was a quiet Indian miracle. They started as a mid-cap jeweler operating right here in Bengaluru. Then, in 2015, they spent $400 million to buy Valcambi, a massive, globally recognized gold refinery tucked away in Switzerland. That single purchase launched the company into the Fortune Global 500. Soon, they were reporting consolidated revenues so massive, they rival India's oldest and largest corporate conglomerates. The market saw them as an untouchable titan. They had the scale, the paperwork, and prestige. When that entire image collapsed overnight, almost no one in the financial world saw it coming. On the evening of June 3, 2026, India's markets regulator, SEBI, released a 109-page interim order. They alleged that the company had misrepresented roughly 15.15 lakh crore rupees. This investigation didn't start with a leaked whistleblower dossier or an aggressive short seller attack. It started with a routine, entirely mundane shareholder complaint filed in March 2024. An attentive reader of the company's accounts noticed that very large trade receivables, money the company was owed for goods it had sold, had been sitting on the books, unpaid for over 2 years. It was a basic question about missing cash, but as regulators pulled that one thread, the financial architecture of a multinational empire completely unspooled. To understand how $180 billion disappears from a balance sheet, you have to follow the ownership chain. The listed Indian parent company, Rajesh Exports, owns a subsidiary called REL Singapore. REL Singapore then holds ownership in Global Gold Refineries, or GGR, based in Switzerland. Finally, GGR owns Valcambi SA. This is the group's actual operating engine, the physical refinery where the gold is melted and processed. Almost all reported revenue flowed up through this chain. This chart shows what Rajesh Exports reported over 5 years, over 15.4 lakh crore rupees. But look at the tiny column next to it. That represents the audited standalone revenue of the actual refinery. Let's zoom in on the calendar year 2023. Valcambi's standalone accounts show they made about 543 crore rupees. Meanwhile, the holding company right above it reported an astonishing 2.92 lakh crore. The audited engine was generating a tiny fraction of the cash being claimed above it. Regulators concluded that 99.8% of the company's subsidiary attributed revenue was a chasm, unsupported by the physical refinery's own books. Rajesh Exports rejects the regulators' findings entirely. Chairman Rajesh Mehta insists the situation is simply a massive misunderstanding of how accounting lines work. The company argues that Valcambi's standalone accounts only measure the value added during processing, the refining margin. Think of this as the EBITDA. In the bullion business, that margin is a razor-thin sliver. But the holding company, GGR, tracks the gross value of all the gold physically passing through the system. A refinery handles hundreds of tons of gold, generating colossal gross turnover, even if it only keeps a fraction of a percent of that wealth as profit. In the world of precious metals, this defense makes logical sense. A massive volume of trade paired with a tiny margin is entirely normal for bullion. But an accounting explanation only works if you have the evidence to back it up. To prove those massive gross fold flows actually happened, a company must produce transaction-level documents, specific customer details, detailed reconciliation statements, and actual invoices. Rajesh Exports claims they sent regulators 400 gigabytes of data. But SEBI says the company consistently failed to produce coherent, verifiable proof of those underlying transactions. As investigators kept looking, they uncovered a catalog of governance issues that made the accounting error defense incredibly difficult to maintain. The most glaring problem was the cash. Regulators tracked hundreds of crores of corporate funds moving directly through the promoter's personal bank accounts, routings that happened entirely without board approval. They also found over 11,000 crore rupees in derivative trades incorrectly booked as company transactions, alongside multi-thousand crore investments in African gold mines that SEBI simply couldn't verify. On top of that, there were millions flowing outward in undisclosed related party dealings, funneling money into a promoter-linked electric vehicle battery venture. When basic revenue documentation is completely missing and corporate cash is quietly routing through personal accounts, the story shifts. Regulators stopped looking at a technical dispute over gross versus net and started looking for massive fund diversion. The regulatory response was swift. The chairman is now barred from the markets, and BDO India has been brought in to conduct a fresh, aggressive forensic audit. The fallout quickly spread to the statutory auditors who signed off on the accounts. Regulators have formally referred them to the National Financial Reporting Authority for scrutiny. The crisis has even spilled into politics. India's state insurer holds a massive 11% stake in the parent company, leading to fierce questions about why public funds were so heavily exposed to this exact risk. While everyone waits for the forensic audit to finish, the damage is already concrete. The mere existence of this investigation has vaporized thousands of crores in real investor wealth. What happened to Rajesh Exports highlights a critical lesson about corporate scale. There is a massive difference between how big a company says it is and how big it can prove it is. In an era of sprawling cross-border subsidiaries, an astronomical top-line revenue number is incredibly seductive. But if those overseas figures cannot be independently verified, they are nothing more than vanity metrics. In modern accounting, the most dangerous number on a balance sheet is the one that is simply too large to question. Because at the end of the day, a business is only as real as the physical documents it can verify.